One plus.
Well, good morning, everybody. Thank you for coming and joining today. Thank you, Brian, for joining online. I appreciate that. And the peanut gallery over here.
Peanut gallery.
Okay, it's good. So thanks for joining today. So our it's a share, right, Aaron?
Yep, sure.
Share, it should be. So, beginning.
Play or the F5 on it.
Oh, okay. So thanks for joining today. So we're going to talk about the trends and solutions for 2025. So yay us. Here we go. So here are the 2025 fashion trends.
Woohoo!
Oh, yeah, look at that.
Yeah.
Would you find any one of those at the store? I don't know. I'm trying to think, is there anyone that
The very second to last, I've got that.
this one,
Yeah,
this
that one
is
I've
the
got.
look?
Yeah. What is
I don't know,
that?
wait, I don't have no idea what that is.
Oh, those are her legs.
Yeah, but I don't know, what it's like a bow or something like that.
Nice.
I'm not sure.
Yeah.
Yeah, so yeah, the trends.
1 second.
So here's going to look at it for this year. We look at, the biggest challenge that you have right now for this year is buyers can't afford monthly payments, right? That's the first one.
Yeah.
And then you have low savings for down payment. That's the other part. You got self-employed or gig workers and you got contingent buyers, right? So I think all those together are kind of what the challenges what we see right now, especially with the higher rate. So what can we do, right? So your options are, you might try a temporary or permanent buy down. We can look at the down payment programs, especially we've done a lot of those for this past year. We've done a couple Covenant. I'm working on one now. And then you can do an FHA loan or whatever, but we would just look at those DPA programs. The other ones, we have bank statement loans or DSCR loans, and I've done a class in the DSCR loans too. And that DSCR means debt service coverage ratio. It's a fancy term for saying, hey, look, can we use can the cash flow of the rental cover the monthly payments? And if it does, then we don't need to get income documentation and everything else. We can just use the profitability of the investment to cover the monthly payment. So that's a great one if you're self-employed or a gig worker or something like that, right? The trick with those is you got to have some down payment, right? You're just not gonna be able to get by with these low down payments on that one. And then the bank statement loans are basically what we'll do is we would say, look, if I'm self-employed, can I use the bank statements and not use my tax returns and qualify that way? And so we have those programs, the DSCR programs. We also have an asset depletion kind of a loan program too. So if you have a ton of dough in the bank and you don't want to, and you don't have a ton of income or anything else, but your income is from that nest egg, you can do those types of loans. And then for contingent buyers, we have bridge loans, we have home equity lines of credit, and that kind of thing. So we have a couple, buy now, sell later strategies are great, on that. So we have these solutions to these challenges that we have, but a lot of people don't think we do, or you may not know you have them. So the idea is that we have been very creative at Brighton Lending to do these particular loans. So the reason I bring up the seller concession cheat sheet is kind of interesting because a lot of people don't know how much you can give. You can get a seller concession, and leveraging seller concession, especially with low down payment or affordability, is a big deal. And rather than reducing purchase price, but it's kind of interesting when you do a primary residence, right? And you're doing less than 10% down, the maximum seller contribution you can get is 3%.
Sorry, this guy, so we can see everything. There you go, thanks.
Okay. Good. Cool. So here's the cool part. So if you do less than 3% down, your maximum seller contribution is 3% of the sales price. Okay. And if you do 10% down or more, you go 6%. And if you do 25% down or more in a second home or a primary second home, it's 9%. So you get a ton of money from a seller concession on that. And then here's the other part. On investment property, you only get 2. Max, correct. And so FHA, you can do 6, and GA, you get 4. but it's way more than that, because you 4% in seller concession, you can use to pay off debt. And other stuff like that, which is kind of cool. So if I have someone who's doing a VA loan and they can't qualify because they have too much debt, I can use seller concessions to pay off the debt. Pretty slick.
Couple questions for you.
Yes.
All right, so conventional second home,
Mhm.
25% down, right, or more.
Yeah. Mhm.
Maximum contribution at 9%
Mhm.
on a second home. Is there any?
No, this is all primary residence and second all together.
Both.
If you do more than 25% down, you get 9.
Okay, so it's both.
Yeah,
Okay.
mhm. Yeah.
Question about the second home, about how long do you have to like occupy the second home? Is there a like time limit where you're supposed to say, I'm there 6 months of the year, or any crazy?
Great
like,
question.
Rules.
So the difference between the two is this, right?
Right.
So perfect example, I'm working on with a client right now. She lives in Pennsylvania, she's buying a home out here, she's gonna rent it to her son. And she might stay there a little bit too, right?
Yeah.
So we were like, well, why don't we use the seller? So the trick is, on the second home basically says, hey, I'm not gonna, I might rent it out,
Mhm.
but not using the rental income to qualify. Okay?
Okay.
So, and then on the second home, it says you'll probably occupy the property less than 14 days a year, is kind of what it says. If you do investment property, it just says I'm never gonna live it. Okay, is it 2? So that's the difference between the two. The interest rates are exactly the same with those two, right? So the interest rate's the same on a second home as an investment property. So the client is like, hey, do you want to spend more money for a down and keep the payment lower, right?
Yeah.
Which is fine, then you can, because you can qualify more. You're not using rental income to offset the payment on a second home. So if she wants to put more money down, she can, and she can get more of a credit,
Mhm.
okay? But she has to put more money down to get the payments lower, right? Or she might want to say, I want to keep more of my money, right? And I can use the investment property, and you can use proposed rental income to offset that payment. So she can qualify maybe for a bigger house,
Yeah.
right? But she only gets 2% versus a 9.
All right. Another question.
Yes.
Important for people to know. For conventional investment property, as a broker,
Yeah.
can they utilize their compensation
Mhm.
towards down payment?
Yes.
And there's
closing
no
costs.
cap?
And closing costs, yeah.
There's no limit or cap on that?
Well, there's a limit. Well, yeah, I mean, you conceivably, you can use your whole commission to pay down closing costs and the whole thing.
Okay.
Yeah.
Yeah,
Before there
that's
used to be a difference between the two, but not anymore.
Okay, perfect.
So you can use your commission for down payment, closing costs and everything else.
Amazing.
Yep. Over here. Okay, so it's kind of cool. So this is just kind of, I get this question all the time, and I have to check this too. I have it right by my desk. I look at it every time to make sure
Yeah.
we're good. But writing off, so the idea, so the one thing you have to remember though, is that if I can get 9% credit, that's fine, but I have to use that 9% as closing cost for the loan. I can't use credit seller concession for down payment. The down payment all has to come from myself, or from the buyer. So I'll just do these temporary, I think there are 2 big strategies right now that we're using, is a temporary buy down and a permanent buy down. So a temporary buy down means that a temporary buy down is a financial arrangement that lowers the mortgage interest rate and monthly payments for a set period of time. Okay, you can choose the periods between 1 or 2 or 3 years. So in other words, it's a temporary buy down, interest rates fixed for the life of the loan, but the first couple of years, the interest rate's gonna be lower. And the cost of the buy down, so the cost of this is the difference between the fixed rate of the loan, temporary buy down rate. So essentially, it's the prepaid upfront and closing, and I'll show this all to you in a second. But basically, it's the difference between what the rate is up here and what the teaser rate, if you will, is down here. And so the gap is what you pay for the cost. So the prepaid difference is escrowed with the loan. And if the loan is refinanced within the buy down period, any prepaid difference will be applied as principal reduction to the outstanding balance. Okay. So there's a lot, but what does this really mean? Okay. Kind of looks like he's flipping you off. Sorry, I didn't understand. So it's a 3, 2, 1 buy down. Okay. And let me show you how it works. So if you're doing, there's people online can't see it too. So if we're doing if you're doing the loan amount here, 665, suppose the rate's 7.25%. I'm just making these numbers. Your payment's 45.36. The first year, the interest rate will reduce by 3%. Okay. So that means you'd be at 4.25%, right? 3% from here to here, it'd be 4.25. Your principal and interest payments 37.21. versus 45.36. There's $1,265 difference, okay? That's for the first year. So in other words, the difference between this payment up here and the principal and interest rate at the rate of 4.25 is 1,265, okay?
Yeah.
Your payment is always gonna be this up here, but what's gonna happen, so yeah, so I'll go back to that in a second. So that's the difference. Or $15,180 per year. Does that make sense? The difference between this and this.
Mhm.
The second year, it'll go to 5.25%. Okay, and so at 5.25%. So 5.25%. The difference is payments 36.72, or a difference at 8.64. Between this one and this,
Mhm.
okay, or $10,000 for that year. And then if you go to 1%, then it's 6.25%. The payments 4,095 are a difference of 442 here and here, or a difference of 5,303. So the difference between what the current payment is, the payment at 7.25, and the payment difference, the differences is
Mhm.
about $30,000. So that's the cost that you're paying. You're not paying any additional fee to get this loan program. What you're really paying is the difference between what the fixed payment would be at 7.25%, and the difference between these different rates.
So that's what they pay to get through.
Correct. So in other words,
30,000.
because what happens is this $30,000 sits in a bucket. Okay, so it sits with the loan, and every month when you're paying $32.71, they're gonna pull $1,265 from the bucket and play the difference. I'll say that again. So in other words, out of this $33,851 sits with this bucket like an escrow account. And every month, when you make, or the first year you're paying $32.71, it'll pull 1,265 from this bucket and make the payment for you.
Mhm.
Okay, so it sits there, it's like an escrow account. And so the next year, so after the first year, 15,000 goes down, now your balance is 15,000 here, right? And so every month it'll pull 864 because you're paying 36.72.
To break even eventually.
Yeah, to cover the cost.
Yeah.
Your payment's always this, yes. So the idea is after this goes to zero, you can't, there's no more reserve, right? So now you gotta pay the full payment, okay? So it's a great idea if you have someone else paying for it. I necessarily wouldn't do it if I had my own money,
Right.
right? Cause you're like, well, I've got them, I mean, why would I do that, right? So it's good if the seller pays for it or if the lender pays for it.
Yeah,
Can both pay for it? Like if you have the
Yes.
seller side,
Mhm.
can the seller pay part of it and the buyer pay part of it?
The buyer can or the lender could,
The lender can too.
yeah.
yeah, this is like such a critical, you know. Piece to, listing brokers, but they gotta understand this right now, because. So if you're gonna like drop a price. 25 Gs, 30 Gs, I
Mhm.
mean, this is obviously you went for the largest one, the
Yeah,
3-2-1 buy
yeah.
down. But even the 2-1 buy down,
Yeah,
it's still a great program. Cause I use this exact strategy to help get multiple offers on my listing that was sitting stale for 48 days.
Wow.
So we got almost 4 offers. We would have had fourth, but the fourth one bowed out because when they found out how much everyone else was willing to pay, they're like, yeah, we can't compete at all. We're not even gonna submit our offer now. But we got 3 offers, we got full price, and our seller didn't even have to pay any closing costs.
yeah.
So we were willing to pay like 26 grand,
Mhm.
for this program, and it brought a lot more buyers. Our phone, my phone was
Yeah.
ringing.
Yeah.
We had a lot more inquiries on how does this program work. There was a lot of buyer brokers who didn't even understand, like, what is this? How do you guys get a rate that low?
Yeah, and I'll show you that later on in the presentation. I'll show you how we can do this. But that's exactly it. You're just leveraging the seller concession if you can in order to do it. Now, the challenge, so the thing is just to remember, the cost of a buy down is the difference between what the permanent rate is and what the temporary buy down rate is. So there's no additional fee. So that's the beauty of it. Because the money stays with the account like an escrow.
Yeah,
So after the first year, what happens? You refinance. What happens if, I know I'm at 4.25, but the cool rates right now are at 5.5. I want to refinance that loan, what do I do? But I have this temporary buy down. This money stays with the account. So when I said before that it acts like an escrow account, the money that is left, if you refinance this loan and there's money left in this gets reduced it reduces the principal balance.
the 30,000.
Whatever's left.
Can't see.
Whatever's left after the 30. So in
Yeah.
other words, you do the first year, you're not on 15.
Yeah.
That $15,000 will and if you refinance the loan, will reduce the principal balance.
Cause it'll go towards down the principal and stuff, like.
Yeah, because this is money that you've
Just like an
prepaid.
extra payment.
Yeah, exactly. It's prepaid. So you either use it, but you don't lose it.
Oh, yeah.
Okay? So you go after 3 years, you go to 0. Hey, it was
Could you
great.
Use it for the refinance.
Yeah, so you get whatever's left. So like anything in an escrow account, when you
That's
refinance that loan, that money gets applied back to you if you've paid it, but this will only get, they don't send the money back to you. They just use it to reduce the principal balance of the loan.
So only the loan, not like, let's say you wanna buy down your rate, you have to have extra cash on hand, that extra money left in your escrow account can't be used to refinance. As the cash, it has to only go towards principal.
Correct, you can't use that to like pay other
Right.
costs and everything
You
else.
can't
No, you're
use it.
correct, correct. This is principal reduction, either helps you make the payments or principal reduction. Okay,
Another question.
yes, sir.
Can you use it all at once for principal reduction if you were refinancing?
Yeah, that's what we would do.
So like, you're like, all that money's gonna be used and it's gonna bring down even more.
Whatever the balance is, yes. In
Yeah.
other words, if there's $15,000 left and your loan's say not 665, whatever it is,
Mhm.
you just reduce the loan balance by whatever's left in that bucket.
That's
So
awesome.
you never lose it.
Yeah, that's
You use
so
it
much
or don't use
better, so much better than the permanent buy downs.
Well, it depends.
It depends,
So
yeah.
This is the kind of thing that we play around with. So let me show you this. So you get the concept. Here's a 2-1 buy down. You can do a 2-1 buy down. Obviously significantly cheaper because you don't have that first year. And this, a lot of people either do the 2 or the 1, you know, whatever, because you are looking at that, but that's the concept. So you use a little bit, you can do a 2-1 buy down, which is great. The other option too is you do a 1-year buy down. And a lot of lenders will do this too. We'll cover the first year for you, get the rate down to 6.25 sometimes.
Yeah,
We can do that. So it's only costs $5,000. So it's not like it's that much. You know what I mean? So on that, but that's maybe a great way to, if I'm putting a listing, we went $5,000, maybe the borrower would, hey, look, I'd rather reduce my payment by $400 for the first year.
Mhm.
I'm definitely gonna use that. You know,
Yeah.
maybe that's more important to me than, you know, a price reduction. So those are the temporary buy downs, okay? And now we all know about the permanent buy down. So this is the opposite. This one is just temporary. This is the permanent buy down, which we're all kind of familiar with. You pay a one-time fee to reduce the interest rate for the life of the loan. Okay?
Yeah.
So you do 7.25 at 0, or you can buy it down to say 3 points. And it'll cost you $19,000, but it'll save you $442, and you're not having rates move up or move down, right? Your payment stays exactly the same.
30-year fixed.
30-year fixed or or you can do any loan program. And this one, I'm just saying it's a 30-year fixed and it's fixed. But it costs you 3% or $19,000. So I could use that $19,000 for the temporary buy down, or I could use it here. Now, the thing is, if you refinance this loan, this is a one-time, you don't get any money back. That's it. It's a one-time fee. So it depends on what your goal is, right? So for the lowest rate for the longest period of time will be better for you, okay?
Mhm.
So part of my strategy is, and just depends what's happening in the marketplace, right? How long will it take us to get to 6.25%? My concern is that if I don't get to 6.25% in the next 3 years,
You're not gonna be
but
able.
I'm not gonna get, you know, like what's gonna happen. So I think, and I've done this in another class before about what goes into interest rates of points. But the idea is the closer, I mean, I think when they say when the dust settles, people are saying that you're probably at 6%, 5.875, maybe 5.5, you know, somewhere around there. And so, yeah, I might use this money if the seller's paying for it, getting down there, and it might take us 3 or 4 years, and I'm already there anyway. You know what I mean? So it just kind of depends on what you want to do with it. Now, the closer we get, these point structures go lower, meaning like maybe 3% will get you at 5.5%, then it might make sense. But I think a lot of people understand this one. It's a little simpler, right? But again, it depends on what you're trying to do and how long you think will it take rates to get to 6.25.
Rates-
If we did a permanent buy down 3 years ago, you would think, hey, rates are definitely coming down, and they're not. So you just don't know, right? So that's kind of what we would do, is just kind of educate. Here are the options, and then let the buyer choose the best one that works.
Yeah.
We did a permanent for our house.
Yeah.
Because the rates are at 7.2, and we bought down at 6 flat. And it's just not broken,
No,
6 flat since a year ago in June.
Yeah, so
Or May.
it depends on what
May
the
of last
cost
year.
was.
it went below
get
6.
No, it never.
Yeah,
did.
it never
It
had.
hasn't broken.
Yeah.
It got
We're
close.
at 6.83 today.
And so the other part too, and this is the other thing, this is another trend that's going on, right? And this is what my boss and I talk about. There's an art in quoting rates. No, seriously, if you quote,
There is.
hey, if I quote 7.25%. Hey, this is what the rate is, right? And this goes for realtors too, meaning that a lot of people now, they know local, they know you're local and everything else, but they really want are deals, you know, something that's coming off market, can you negotiate really hard for me? What's all this? The same thing with lenders. They're asking us, yeah, here's 7.25, but I see this rate for 6.25. Yours is way too high.
Yeah,
I'm like, well, why would you pay the 3%, right?
Yeah.
And so the idea is now I'm always quoting rates with the 3% on it to stay competitive. Because if you go online, it's a weird because if you go online, you click on these interest rates, that's what they're all quoting. So it's just that's one of the new trends too for this year too. So any questions, Brian? You got any questions on the temporary buy down and the permanent buy down? Cool.
Nope.
Good. So here's kind of like how it looks all together, right? This is how we look at it for strategy wise. So if we have a sales price at 850, you do 20% down, your rate says 6.875, the payment's 4467. Now, if you do a 20K reduction, $25,000 reduction. So now your loan amount is 830, or your purchase price is 830, your loan amount 664. You'll say your payment goes to 4362. And I think that savings here, the savings is $105. So you can reduce the payment by 25,000 and save $105. Great, you want to do that.
yeah,
The other option is do the permanent buy down. So for that same amount, I can do the 20, you do the same thing. Now I get 6.25, 6 1/8. Kind of what you did, right?
Mhm.
6 1/8 at 3% or an extra 20 grand. So now I've saved $335 a month for the life of the loan. Okay. So for the same, and that's only 20,000. And the other one, you're option 25, right? So that's one option. Option 2 is to do the 2-1 buy down. That'll cost me $15,575, which is cheaper than this one. And my payment for the first year is $3,599. Now that'll change, right? So that'll save me $869 between this one and this one. That's one option. The third option too is the 3-2-1 buy down. That'll cost me $30,000. And now my payment's 1,270 for the first year.
jeez.
So it's leveraging different ways to do that, right? So I really think my job has to educate buyer to know that, but also the realtor to understand how to negotiate that. You might know, I mean, because the first thing everyone does is that's way too high. Well, how about we try this? Yeah, how about we try this or do this? Is there maybe some wiggle room? Now, obviously, if it's right off the gate and it's competitive, you're probably not gonna be able to do this, right?
Right,
You know, or you can offer higher and ask them to credit back again, but that, you know, that's the listing.
but then
agent has
if it
to understand
doesn't
what you're getting.
appraise,
Yeah,
you got all those issues too.
For sure. But this is a kind of like this, because this, and I'll bring this to clients too, if we decide what we want to do. Here's what it looks like.
Mhm.
And so it depends on what you want, right? So, hey, maybe 6 1/8 might be good, and I know and it gets me down, I'm not have to worry about it, so it just depends. And this is the cost between these two, okay? So now that we have those concepts. And this is what builders are doing too. So a lot of ways you see these lower interest rates because these builders are paying some of these costs because they have. They're willing to pay 50 to 60 grand less.
Right.
Because they've got it baked into the price of the house. That's why you won't be able to negotiate on price. So let me show you this. Again, I'm gonna show you.
Get crazy with the cheese whiz.
Okay,
Oh.
here's how it works. Alright, suppose you do a purchase price at 850. Yep, sorry. And the seller concession is 6% or 51,000, okay? But instead of doing a 30-year fix, let's do a 7-year arm. Okay,
Oh,
interest rates in the arm are cheaper, but the points are maybe a little bit more, so it's kind of weird on how and depending on what's going on with the market right now.
mhm.
But we'll use a permanent buy down. And then we'll add a 3-2-1 buy down. So the thing is, you can stack these together. You can do a permanent buy down and you can do a temporary buy down all in the same deal.
Wow.
Yep. So, show you this. Boom, okay. I want to show you. So this,
I was gonna say.
so here's the deal. I do a 850 purchase price. I do 20% down.
Yep,
Okay, on a 5-year arm, I can get you 5.625% at 2 points. So you'll have to pay 2% of the loan amount, right? To get 5.625 or 13,600 to get it down.
uh-huh,
The mind is only 7-year arm, so it's the interest rate's fixed for the first 7 years. But then we can add a temporary buy down on the 3-2-1, so it's just 28,000. So 13,600 plus 28,977 equals 42,000. So I'm using less than my 6%.
Mhm.
I use 42,000 and take a look for the first year, my interest rate is 2.625%.
Dang.
3.625, 4.625, and 5.625. So first year, second year, and years 4 through 7, it goes to 5.625.
Wow.
So when you see builders advertising 2.5% or whatever it is,
They're probably
This is
doing
what they're
something like
doing.
that. Yeah.
right? A good loan officer is gonna tell them, hey, you wanna sell your inventory? This is how you do it. It only costs you 42,000. You're willing to pay that anyway. You know, the trick is if you're doing someone who's doing 3% down.
Yeah.
Then there's different ways to work with it too, but I'm saying if you just get 10 down or 20% down, you can get up to 6%. And that's what you're using. Okay. So again, if you're on the opposite side, if you're listing your house. If you're listing the house, I know, or maybe that's part of your, I don't wanna say it. Part of your pricing strategy is to build that in a little bit, maybe add a little, make it, add that into the purchase price, then offer this. And then you might be somewhere else, but that's what builders are doing.
That's crazy.
Builders are not reducing purchase price, they're giving you the discount.
Guaranteed if you, yeah, you put that in your call about the 2.625, introductory interest rate for first year.
Yep. You'll get called.
People, yeah, your phone's gonna be blowing up.
They're gonna say, what's this about? This is.
Yeah, they're
Right.
like, is this, like, how
Yeah.
can you offer a rate that low when rates are almost 7?
So the other part too is that if you, I mean, I don't do a lot of listing presentations. But if you wanna rope me in, I'd be more than happy to show this to the seller. And say, look, here's one strategy you can, that's part of it, or
Yeah.
you know it and you can talk about it, but it's just whatever it is. These are the kinds of things that make you stand apart. Yeah.
Well, our sellers, literally, they were contemplating canceling and waiting until next
Oh.
spring. They were going to actually do that. Until you were
Yeah, yeah.
like, Eric, why not, let's offer this,
Yeah, yeah.
let's show them what it's gonna look like to give, all the information about the 2-1 buy down.
Yeah.
And they were like, oh, you guys are geniuses. They literally were like, this is amazing.
Yeah.
I've never even heard of this.
Yeah.
And we didn't reduce it anymore.
Well,
We
just create-
offered that.
Yeah, and it created
And I put it in the marketing remarks to say,
Mhm.
ask about the
Yeah.
seller incentive of, the 2-1 buy down rate, interest rate at what was it?
4875.
4.875. As soon as we put that in there, like the next day I started getting calls.
Well, I got 2 calls.
You got
Yeah,
calls
yeah, I got
too,
the,
yeah.
yeah, the one, there was two people.
Yeah,
But-
so it makes a huge difference. So, I mean, you look at what does a price reduction do in your strategy, and I talked about this a little bit in my last class about, oh no, my listing's not selling, now
Yeah.
what?
Yeah, yeah,
Like, what do I do? These are the types of things that you need to know how this works, and you need to, be able to discuss this with your seller so that they can understand that there are some different options out there that probably 90% of brokers aren't even using.
well, yeah, or the lender doesn't know about it.
Or
That's
the
other part,
lenders.
too, the lender won't bring
Yeah,
your
you're
client
right.
up to it, and that's the other thing, is like, they have to understand the program, and so I got so many people like, well, this is the only program you offer, and.
There
I would
was
like
a
to say
lender
yes.
that called, and asked how we're doing this.
Oh, really?
Yeah, that's scary.
Well, and I remember I was very fixated on getting more cash for the down payment
Yeah.
than anything. And then we were like, well, we'll just throw more money at the down payment, but then like the amount, it reduced the price or our
Yeah, you're
monthly.
Better off,
Versus
right,
it was like
yeah.
a few $100s off
Yeah.
from the buy down versus
Yep.
the actual.
Yep.
Cause I was like, oh, maybe we don't have to put all of our down payment in now. We can actually still hit the 20% and then use the rest of it for.
Yeah.
Other stuff.
You probably saved $500, probably $400, $450 a month.
I think we did,
Oh, no.
yeah, we just were like $550 a month.
Yeah,
Right.
by getting it down and letting the seller pay for it, you know,
We had seller and lender.
Yeah.
Kind of,
yeah,
so.
that combination, that's kind of what you do. Any questions of that? Brian, does that make sense somewhat?
Yeah.
Cool, thank you.
Morning.
Morning.
Yeah.
All right, so, what's this in here? This is, what I do this, why is that? Sorry, this is there, okay. So that's part of our payment affordability program on the buy side, right, for the buyers. And we also have the sell side too. So that's kind of what the idea is. The idea is when I talk about payment affordability, hear those programs and stuff like that.
Yeah.
Okay, buyers, consultants, okay. So as we move off that topic, here is you're turning nest egg into buying power. So here's a client who's got a ton of dough, but I don't really have any income. I'm not working. I got a bunch of money, or I have this business and I don't want to deal with all this. Can I use a loan? Can I get a loan and using my assets? And so this is kind of what it is. So, traditional income may not tell the whole story of your financial thing. We use asset-based loan programs. You have a simple solution to secure financing, no pay stubs, no tax returns, or other traditional income documentation required.
Wow.
So this means I have a ton of money sitting in a brokerage account, but I know how to finance my own stuff. I know I'm using my income. I don't, I can't get a traditional loan. So why does this program stand out? Designed for unique financial profiles, both individuals, self-employed or professionals or retired with significant assets. Gives you flexible payment options. And there's forgiving guidelines, even with less than perfect credit scores. So the concept behind this is that you have enough money to qualify in the account to cover the payments. And I'll show you what that means. So here's the concept. So you have a traditional transaction type. So you have a purchase, you can do purchase, rate term, refinance, cash out, whatever you want. Okay. We will use 100% of your checking and savings accounts. We use 80% of your stocks, bonds, and mutual funds, and 70% of your IRA, 401k, or self-employed retirement accounts for borrowers under 59.5.
Under.
Yeah, you can be under 59.5. So I have many investors that will say, yeah, we can use your IRA accounts and everything else as part of your total package, part of your assets. And you can be under 59.5. Some of them say you can't, but we have a bunch of different programs. So the concept is this. Does my net eligible assets, these,
Yep.
is it greater than the loan amount plus 60 months of monthly payments? Okay, so is it? I don't know, but that's kind of the concept. Do we have enough money to cover the loan amounts plus 60 months of payments in another account taking these haircuts?
Right.
So if I have a $700,000 loan amount and I have 60 months of debts, so I need 60 months of monthly debt. So I have 10,000 a month that I'm paying.
Yeah.
Times 60 is 600,000. Okay. So do I have 700,000 plus the 600,000? Do I have 1.3 million? Must have more than 1.3 and then eligible assets to qualify. That's the concept. Now, every investor has to be slightly different, but that's the idea. Do you have enough money to cover the loan amount plus your debts in a brokerage account, some other account that doesn't have, with those haircuts?
Yep.
That's the idea. Now, the interest rates on these are going to be higher than like traditional type of loans because of the riskiness of it, but they're not crazy, right? So depending on how much you're putting down, now you're not going to be able to do, a 10% down payment. These are going to be 30 to 40, percent down, but you have enough for your loan amount to cover everything else. That make sense?
Yeah.
But these are cool programming. They're easy to do. I mean, you have the numbers that you don't, right? Next one here. So then we have our bank statement loans. So financing can work as hard as you. For independent income earners, ideal for self-employed professionals, small business owners, gig workers, and those kinds of things. So we can use, you can do as low as 10, we have one that's low as 10% down, but we would just look at your your bank statements and see the income coming in and that kind of thing. So it's not that hard. It's just that we need everything else in there. But yeah, that's what we can look at if you have, if you're self-employed and then you don't have enough of the assets, but we can document other ways to do it. Okay. Now, this won't be for down payment assistance or anything like that. These are separate ones outside of that. Okay. These are what we call non-QM. QM means qualified mortgages. So bank statement loans and the other ones I was talking about are non-QM loans. Okay. And then we have the cash flow loan. This is a DSCR loan we went through. I did a class on that too, where you use they're cash flow driven. But you can use short-term rentals, long-term rentals too. Expanded property choices. You can do non-marketable condos, condotels, and other things like that, as long as it cash flows, right? We don't need pay stubs or tax returns or anything like that. Okay. Then last one, and then we have reverse mortgages. So this is part of it, is that We have the ability to reverse mortgages, so if you have someone who's trying to sell their house, contingent offer, they wanna buy something else. Maybe we can use a reverse mortgage if they're over 59 or if they're 62. Okay, that's one option. For that. But the other group is the buy now, sell later folks, right? So then we have a cross collateralization or a bridge loan. So if somebody wants to sell their house and keep buying now and sell later, we have the ability to do a cross collateralization or bridge loan. And that's using the equity in their current home. To buy for the down payment on the new home. So for example, we're gonna do a lien on 2 different properties. So we buy the one, boom, put the lien here, cover both with one deed of trust. When you sell this house.
Yep.
This goes away and we do a permanent financing on this house. So it's a temporary loan. Okay. That's your strategy there. We did a class on that too.
Yeah,
So all these have been classes on, so we can dive into that. And then a temporary loan encumbers both properties. Once the departing or residence is sold, the temporary loan is paid off and the new home receives permanent financing. The maximum on the loan amount, the maximum amount in the permanent financing is based on
income.
income. That's that one. And then I think that was the last one, so I know it's kind of long, sorry.
Good.
Yeah, but that's kind of the idea. So the biggest one, I guess the big takeaway is that we have these QM loan programs of the cross collateralization. We have reverse mortgages, we have cash flow loans, bank statement loans, and then your asset. Completion. Those are the non-QM kind of things. They're out of the box.
Yep.
But then we have this great payment for the program that you guys can work on to do that. But I think that these are the challenges that we're working with all the time. So,
Right,
any questions on that?
good stuff, man.
Yeah.
Thank you, Aaron.
Great.
That was my Saturday night putting this together.
Nice.
Solutions.
Yeah, but it's funny because I have these different things in different spots. I kind of have and put them all together. But this is the kind of stuff. Thanks for coming, Brian. I appreciate it. But this is the kind of stuff we talk about once a month. There's some good stuff in here, and
Yeah.
it's good stuff. But especially trying to use those temporary buy downs. And if you have questions on it, I'd be more than happy to meet up, go over it in more details so you can see it. I know how it works, especially doing a listing presentation or that kind of thing. Or if you see a listing that my buyers like, it's been on the market for 40 days. That's, what can we do?
Mhm. That's good stuff.
Cool. Yeah.
Thank you, Aaron.
Thank you.
Thank you, Brian and Kristen, for showing up.
Is that what that was?
Yep.
You did.
Good.
So I'd stop the recording then.
Gotta escape. There you go.
I can't see.
Stop share.
There.
Nope, stop share the red.
Oh,
There you go. There you go.
and the recording will be off, right?
Yep, stop.